Hello, my name's Mark, and you're watching Resource Talks. Today, I'm joined by Lance Roberts, who is the Chief Strategist at RIA Advisors, a money management firm based in Houston, Texas. Lance has an investing background that spans more than 25 years, and he's the author of the Real Investment Report, a weekly subscriber-based newsletter that is read by over 100,000 people. Before we hear from Lance, keep in mind that despite his impressive credentials, he cannot give you, a stranger listening online, personal financial advice. So take everything you hear with a pinch of salt and do more research before taking any decisions with your money. With that said, Lance, thank you for coming on the show.
I'm glad to be here. Thank you. Yes, and lots of salt, please.
I'd like to start by getting your big picture view. So if we were in a space station orbiting Earth, looking down on the global economy and markets, what would we see right about now?
It's interesting right now because there's such a conundrum between what people think should be happening and what is happening. And right now, a lot of people, especially and we've seen this over the last year. Last year, lots of calls for recession. Going to have a recession, got to have a recession, inverted yield curves. This is, going to be bad for the economy. Fed's hiking interest rates. It's got to be terrible for the economy. And historically, that certainly makes a ton of sense and historically is accurate. But yet here we are in the first 2 quarters of this year, GDP's ticked off a little over 2% growth. Estimates right now for third quarter from the Atlanta Fed are now 5.8% growth for the economy in the third quarter. So certainly no signs of concern about a recession here. Now, the problem for that is that, we just had very strong retail sales numbers. That's problematic for the Fed because they need to hike interest rates to combat inflation. So now we've got this tug of war between the Federal Reserve, which is trying to hike interest rates to slow economic growth, to bring down inflation, which would typically normally evolve into a recession at some point, versus what's actually happening in the economy, which is this really quite stellar economic growth, and earnings are doing okay for companies, nothing really terrible. So it's a real conundrum for investors about where to be invested, what's working, what's not working, those type of things. So, even for portfolio managers myself, this is a very difficult year, particularly when you look at the first 5 months of the year. You've had this very strong advance in the market, driven mostly by about 7 stocks. Lately, we've had a little bit of a broadening of the rally, which has been encouraging. And this correction we've had over the last couple of weeks, very much expected. We've been talking about the need for a 3 to 5% correction now for for probably the whole month of July, saying markets needed a bit of a pullback here. So what's happening is completely ordinary and normal, but again, certainly nothing that really kind of dovetails into that fear of a big recession or a market crash, those type of things. So it's a tough challenge, depends on where you're invested right now.
Earlier this month, JP Morgan's chief economist said the bank was no longer predicting a US recession for 2023. And in addition, Bank of America put out a report saying that they were retracting their forecast for a US contraction in 2024. But Lance, you don't seem to be singing such a happy tune, though, based on what I've read of your recent blog posts. You wrote an article in August saying that federal tax receipts are falling and that this could be an ominous signal of a coming recession. So could you explain that thesis to us and give us a rough idea of the time frame that you'd be thinking of?
Yeah, so that's the interesting conundrum, right? And so again, and you kind of have to read more than one article, because I produce a bevy of articles every week and on our website, and sometimes they're a little bit more bearish leaning when there's something like tax receipts, which have a very big decline. But I've also had a lot of articles out lately talking about the bull rally and why we have to be invested in those type of things, because they don't always dovetail with each other. So, you don't want to take one piece of analysis and say, oh, well, that's the thing, right? Because we've had the thing now for over a year and a half, whether it was inverted yield curves or higher Fed funds rate or leading economic indicators or a variety of economic indicators kind of in recessionary territory. Yeah, we don't have a recession, right? So this is why you're now seeing Goldman Sachs and others retracting their recession forecast. They were very much in that recession camp last year, expecting one for this year. We've been pretty vocal. I wrote one in very early part of 2022 saying, I don't see a recession until maybe the end of 23. And that was back then. And now, because of all the stimulus, we may not see a recession until 24 or maybe even early 25. So it's definitely out there. And this is one thing we're seeing coming in right now, of course. Again, we just had very strong economic growth estimates coming in. And that's because of that Inflation Reduction Act, which is interesting because the Inflation Reduction Act is taking longer than people thought to actually impact the economy, because as President Obama found out in 2008, we passed an infrastructure spending bill then, and it didn't have an immediate impact on the economy. And what he said was, well, shovel-ready jobs weren't actually as shovel-ready as I thought they were. And that's a very true statement, because if I want to build something, I've got to get it permitted, designed. It takes a lot of time before I actually crack dirt to start building something. Well, now we're starting to see, like the recent article in Wall Street Journal talking about this big manufacturing AI plant in North Carolina getting built, $500 million. That's all stemming from that Inflation Reduction Act. So that money's now hitting the economy. That's what's creating the short-term boost of economic growth, and subsequent inflation tick up will come with that. But there's no other spending bill on the other side of this. So once this money leaves the economy, then we're likely going to start to see the resurgence of some of that economic weakness. And what tax receipts are telling us is that we've already got some of that in, because tax receipts are falling. And yet there are some individual things that are going on. California had a late filing for taxes, but that doesn't really account for the magnitude of the decline we're seeing in tax receipts. So this really suggests that the average income earner is paying less in taxes. Corporations are paying less in taxes due to weaker revenue. And we have seen revenues fall for companies over the last year. So all this is perfectly normal within the lines. But historically, falling tax receipts are a leading indicator for recessionary outcomes in the economy, because it's telling you the economy is slowing down. But this is a key point. So imagine that we were growing at 2% growth last year, and we went into kind of a slowdown in the economy. See, we would be in a recession now. But because of all that liquidity that we put into the economy back in 2020, that $5 trillion worth of stimulus, the economy on a nominal basis was growing near 12%. So in order to get into a recessionary environment, I've got to reduce economic growth from 12 to 10 to 8 to 6 to 4 to 2 to 0, right? I've got to reduce a lot of that economic growth in order to get to a recession. But because that economic growth surge was so big, because of $5 trillion in stimulus, it's going to take time for that ball to roll downhill to get to the bottom of the hill, right? To call it a recession. We're getting there. It's just going to take a lot longer time for us to actually reduce that economic surge to get it back into recessionary territory.
Your colleague at RIA Advisors, Michael Lebowitz, wrote an article last week arguing that, and I quote, "The fumes of pandemic stimulus and related personal consumption continue to keep the economy running strong despite the increasing headwinds of high interest rates." But isn't this explanation of pandemic checks wearing a bit thin now in the second half of 2023?
It is, but remember, and yeah, you're absolutely right. We've been looking at that for quite some time, but it's not just the stimulus checks, right? It's the stimulus checks. It's $1.7 trillion worth of the Inflation Reduction Act, which was just passed last year. So that surge of money. So when we take a look at M2, right? That's the money supply. As a percentage of GDP, it's still extremely elevated. And remember the way money works in the economy. Mark, I'm going to buy something from you, right? I'm going to buy your shirt. So I give you $5. So I have your shirt. You now have my $5, right? Now, if that's where the transaction ended, the stimulus would be over very quickly, right? And the economy would return back to normal very fast. But that's not where the transaction ends, because you take my $5 and then you go buy gasoline with it for your car. right? So you bought, half a pint of gas. So, so you spend $5 there. Well, now the retail store that sold you the gas has the $5. So now they spend it on inventory. Well, that inventory has to get bought from the manufacturer of that inventory. So they now have that $5. You have your inventory. Well, in order to build that inventory, they need the commodity components. So that $5 gets spent again. So the point is that while M2 as a percentage of GDP is declining, it's still extremely elevated. There's still a lot of money floating around the system right now that's keeping this economic growth more elevated than what we thought it should be. And so that was his point. That's my point about money supply and stimulus. There's still a lot of money, and that Inflation Reduction Act is the latest invention of that monetary supply. But beyond that, right? So now talking about money wearing thin. Once we get past this boost caused by the $1.7 trillion Inflation Reduction Act, there's no other bills on the other side of this. And we're about to restart student loan payments, which is going to extract more liquidity from the market. So you're absolutely right. The excuse of economic growth driven by stimulus is wearing thin. And once we get past the Inflation Reduction Act, which came after that stimulus spending, then that's where we're likely going to see the next leg of a potential recessionary type environment take hold. My best guess, by the way.
Right. Yeah.
Lots of salt.
I'd like to just point out that this shirt actually costs a lot more than $5, but I'll just take it as the hypothetical it was intended as.
Yeah, the hypothetical. Lots of salt, like I said.
Yeah. There's been a lot of speculation about how long it should take for raised interest rates to show up in weaker demand. But recently I interviewed Michael Howell, the CEO of Cross Border Capital in London. And he argued that the economy might not be as interest rate sensitive as textbook models suggest. And he pointed out that low interest rates didn't help growth much after the financial crisis and COVID. So why should high interest rates hamper the economy now? And his rationale was that with aging demographics and household formation rates low, fewer people are buying consumer durables, so interest rates don't matter so much in that context of taking out finance. And also businesses in the service sectors aren't as capital intensive as manufacturing firms. And so perhaps the move in recent decades of Western economies towards service sector industries has made the economy far less interest rate sensitive than textbooks written in the 1970s would make us believe. So how would you react to that narrative?
It's got merit to it. The issue is with interest rates is twofold. One is that interest rates are a function of the ability to repay debt, right? So we have 32 trillion in government debt and climbing, and now interest service on that debt alone will be north of $1 trillion. So essentially 1/5 of all income coming into the U.S. government is spent solely on interest service, right? So that doesn't leave anything left over for productive investment. The second thing is that debt does not create economic growth. And this is clearly laid out since 1980, that over time, as we've increased our deficit spending, it has not led to higher rates of economic growth. More spending driven by debt does not create growth because it's non-productive investment. And again, to his point, he's absolutely right. Service sectors are very less intensive, and they are also basically have no multiplier of economic growth in the economy, unlike manufacturing. Back in the 1960s, we were 80% manufacturing, 20% service, and we had an 8% growth rate. Now we're 80% service, 20% manufacturing, with a 2% growth rate since the turn of the century. So yes, more debt does not create economic growth. It actually retards economic growth, because the more debt you have, the more money that is diverted from productive investment, in other words, starting a business or whatever it is, to servicing the debt. So what consumers are faced with is this impact of higher interest rates, taking more of their discretionary income to service credit card debt, leaves less money to go buy washers, dryers, cars, have experiences, those type of things. So and again, when you take a look at the average household, they need more than $16,000 worth of debt every year just to sustain their standard of living. So it's just to the point to where they have to have debt in order to sustain their living. So that's where economic growth comes from, because we're 70% consumption based in the US economy. So the more that debt costs, the less there is available for me to spend. And so economic growth is going to slow. So the argument that debt doesn't matter matters a lot, because interest rates and the economic growth that we've had has been a function of a low interest rate environment. At higher interest rates, there's less debt to be financed, which in turn leads to less consumption within the overall economy.
You said that service sector spending doesn't have a multiplier effect, and I'm a bit curious about what you mean, because if I go and buy a coffee, then the barista spends a portion of that money, and the person who receives that spending spends a portion. So in the Keynesian sense, there is a multiplier, isn't there?
Yeah, it's a very low multiplier. So if we take a look at the multiplier effect of manufacturing, it's about 5 to 1. Services is about 1 to 1. It's not now government spending, because you're recycling tax dollars, is a negative multiplier, because all you're doing is taking money from one party to give it to another. So it's actually a negative multiplier in the economy. But you're absolutely right. There is a multiplier effect of service spending. It's just very low. Again, if I pay my Uber driver, which is a low cost, right? So let's use your example. You go buy a cup of coffee. So you go buy a cup of coffee, you give your $5 for your cup of coffee, and then it goes to pay employee salaries, rent, expenses, those type of things. But there's not a big distribution effect outside of that. And so once it gets through that initial process, there's not a lot of recycling. However, if you think about building a house, right? In order to build a house, this is a huge multiplier effect economy. And it's why housing is such an important component of economic growth, even though it's a small fraction of the economy, is because I've got to hire engineers and architects to design it. I've got to hire, I've got to pay fees and things to the local approval boards to get it approved. And then I've got to hire the workers, and I have to buy all the components to build a house, which require a lot of commodities. And the throughput of every dollar spent in building a house has a far wider reaching effect on the overall economy. This is why manufacturing is very important to economies, and why we're so focused on trying to bring manufacturing back home, because it's higher paying jobs. It creates more wealth and economic prosperity than service sector jobs, which are generally lower paying, less productive parts of the overall economy.
You said that in order to understand your views, it was necessary to read more than just one article. So I'd like to demonstrate that I did read another article, which was entitled, "The Market is Detached from the Real Economy." And this came out earlier this month. And in that in that article, you presented data that showed real corporate profits as a proportion of GDP are way above where they were in the noughties, where they were in the 90s, where they were in the 80s. So doesn't that strength in corporate profits actually support high stock valuations?
It does in the short term. And of course, profits are a function of kind of what happens, but there's a couple of caveats to corporate profits today that are a tad different than what we've seen previously. So, first of all, stock buybacks, which have become a rampant part of overall society and the financial markets, has been diverting capital. So while companies can produce, and remember, these are profits per share that we're talking about in a lot of, and when we talk about earnings, we talk about earnings per share, we talk about corporate profits on a per share basis. So if I reduce the number of shares outstanding, it improves profits. But they just look at raw profits across the board. That has also been a function of a lot of things that don't generate better economic growth overall, and also don't really delve into supporting very high valuations paid for companies. Because again, when you look at the suppression of wages over time, which has been a big benefactor to corporate profitability, that doesn't lead to better economic prosperity, which also too, when we look at the top line of earnings, which is revenue growth, that's what's actually coming out of the economy. So again, when I look at, what am I actually paying for in a dollar's worth of profits or a dollar's worth of earnings? Is that being justified by the underlying economic growth within the economy? Because again, everything starts at the top line. That's on income. So did you go out and buy that shirt for $3 or $5 or $10 or $20, whatever you paid for it? That's what the company received at the top line. Then I've got to go through, I've got to pay all my costs. I've got to do all my other stuff. And at the bottom, that's my profitability. So how do I expand profitability at the top line? Well, I do that by suppressing all the other factors in between the cost, right? So I try to reduce my cost as much as possible. How do I do that? Well, I outsource jobs overseas to cheaper labor markets. I pay lower wages here in the United States. I do a variety of other things. I automate jobs. I use AI, whatever it is, in order to boost that profitability. And of course, what we saw, and the current level of profitability in particular is unsustainable, because the profitability upshoot we saw in 2020 was a function of shutting down the economy, laying off half the workforce, and then giving a whole bunch of people money to go spend, which they did. But now I've got half the workforce. I've laid off, the biggest expense in any company's payroll. So I've gotten rid of half of that. I've automated a bunch of jobs I didn't have before. So profitability just shot through the roof for these companies. Well, that's not sustainable, because you don't have that. We're now hiring all these people back to work, right? We're back to 3.5% unemployment, blah, blah, blah. They're all back to work. So sustaining that extraordinarily high level of profitability is unsustainable going forward, because we're going to return back to a normal economic environment. So the valuations people are paying today are going to be much more problematic to hang on to in the future as the economy normalizes post-pandemic.
Now we've got a feel for your macro outlook, I'd like to pivot into talking about your investing style. So from what I know about your work, I'd say that you're a hybrid between a value investor focused on fundamentals and a momentum investor who's very conscious of short-term market signals. Is that right?
Right. It's very, very factual, yes.
Right. Is that like being a bit of a Jekyll and Hyde character, though? How do you reconcile the two? Because, for example, you mentioned on a different podcast that you'd recently bought Apple shares despite viewing them as being overvalued from a fundamentals perspective. So do you have to sort of hold your nose as you're buying something like that, which you don't think is good value?
Yeah, absolutely you do. There's a couple of things. So, and this is always the one big thing that as individuals we have to be careful of. And that is getting this kind of confirmation bias in our investing, right? So I talk to a lot of people who are like, I think the world's going to end and the dollar is going to go to zero. And, so I have all my money in gold. There's nothing wrong with that, right? As long as you're happy with it, that's completely fine. I have other people I talk to and like, oh, I just think AI is the thing and that's going to change the whole world. So I'm all in AI stocks, right? So there's these extremes that exist. Well, the problem with once you get into one of these extremes, and that can be simply, I'm only a fundamental value investor, or I'm only a growth investor. Those can be extremes too. The problem is once you niche yourself into one of these extremes in terms of views, all you do is look for information that confirms that view. So you start reading only everything that confirms that the world is going to end, or you only read stuff that says AI is going to take over the world, whatever it is. But markets don't work that way long time. And in the short term, markets can do very unpredictable things. And we have a very different, I've been managing money for 35 years. And the market today is vastly different than any other market I've been in previously. And this has been something that really started in 2008 in particular, and has been growing, which has been this intervention of central banks with liquidity, combined with this rise in ETF investing, right? I can just buy a basket of stocks in ETF. Well, the problem with ETFs, and again, there's nothing wrong. I'm not saying there's a problem with ETFs, but the problem they create within the markets is that every time I funnel $1 into an ETF or this basket of stocks, that money then goes into the individual stocks underneath it. And so where we are today is because of all the passive flows that go into ETFs, they funnel into the top 10 stocks of the S&P 500 index because of the weighting that they have. So take Apple as an example. Apple is in about 350 different ETFs. So every time somebody buys one of those ETFs, there's a dollar going into a share of Apple. And that absorbs about 5% of the overall index. So there's an outsized weighting of money flows caused by these passive indexes that are shoveling into these top 10 mega cap companies. And that's why last year during the 2022 decline, the market really didn't decline that much overall because those big stocks were holding up the market. It's kind of think like an iceberg, right? You look at an iceberg, you only see the little bit above the surface, but below it, right, everything's underwater. Well, you took a look at most of the stocks in the indexes last year. They were down 30, 40, 50, 60, 70, 80. There were some stocks down 90% in 2022, but Apple, Microsoft, Google, they weren't. And that was because of all those passive flows. So as an investor, I have to compensate for those flows. I may not like Apple and Microsoft fundamentally, but I know that because of all the money being shoveled into ETFs by investors, and they're not passive, they're just buying an ETF rather than a stock, right? So they're buying iRobot because they think AI stocks are going off. So they buy that ETF. So they buy ETFs, that shovels money into those top 10 stocks. So I have to own some of those stocks in my portfolio. Otherwise, and this year has been a great example, in the first 5 months of this year, the market's up 15%. 7 stocks accounted for 90% of that rally. So if you didn't own those 7 stocks, you did not get, or if you own those 7 stocks, but then a bunch of other stuff, like I do in an allocated portfolio, you vastly underperform that rally. And that's been the big divergence this year. And so I am a fundamental investor. I believe in fundamental value stocks, but fundamental value stocks have a very long window. I've got to buy something today based on values and expect a return over 3 to 5 years. Well, most clients and most individuals, they don't look at the market that way. They look at what did the market do yesterday and what is it doing today and how am I doing? And so we've got a very short-term mentality in terms of investors. So I've got to have a part of my portfolio that's performing with that while I'm allowing that value side of my portfolio to both protect capital in the short term against market volatility, but provide long-term appreciation for clients and dividends. So that's why you have to be a bit of a hybrid in this market. You've got to be a little bit of Jekyll and Hyde to navigate this market because of the bifurcation being caused by liquidity pushes by the Federal Reserve, by passive indexing, et cetera. It's changed the market environment we live in by a very large margin.
So if you're worried about keeping up with the S&P 500, wouldn't it make sense to buy shares in an ETF rather than trying to handpick some of the companies that make up a large proportion of it? Because presumably some unexpected event could tank Apple shares, but not the S&P 500 more generally. And in which case you'd end up holding a company that you thought was overvalued and at the same time wasn't helping you keep up with the benchmark.
Well, that's why, well, first of all, we don't own 5% of Apple in our portfolio, right? So we have a smaller weighting just for that reason. But also we have a lot of technical parameters that we use to, protect downside risk in portfolios. So we will sell that position if it begins to underperform. It will sell out. So if we see a rotation out of ETFs, but that will also come as, again, it's not going to be a function of, oh, the S&P is doing fine and Apple's doing terrible. It'll be a function of everything's doing bad at once. So once the S&P begins to drag, and that'll be a function of money leaving ETFs, dragging on Apple, Microsoft, Google, Amazon, et cetera, then we'll sell those positions and raise capital. We're not buy and hold investors. But, we do run an ETF portfolio as well. So we have a portfolio that's all ETFs for just that reason. People are like, I don't really care about the individual stocks. I just want kind of a return over time with some risk management. So we have an ETF portfolio for that. It's great for accounts with smaller values, people just starting out investing, et cetera. It's a great portfolio for that. For our other clients that are larger, higher net worth, they like individual stocks because they like the stories, they like the thesis, they like the value, they like the dividend income that comes from them because you get higher dividend yields. We have stocks in our portfolio paying 6, 7, 8% yields, right, on dividends. So, that's an additional flow of income coming into the portfolio along with our bond income. And then we also have potential capital appreciation as that as well. So it really depends on what your goals are. But if you're just going to buy an S&P 500 ETF, there's absolutely nothing wrong with that. You can certainly do that. You'll benchmark the performance. You don't need me to manage your money to do that. You can do that yourself fairly cheaply. Just buy an S&P index fund at a brokerage firm and dollar cost average into it every month. You'll be fine.
Let's talk about the sectors that you like at this moment. Real estate investment trusts, or REITs, seem to have not gotten the memo about a stock market rally in 2023, with the Vanguard REIT index flat year to date and down 20% over the last 12 months. So are REITs a sector that you consider allocating to right now?
We're actually allocating more towards home builders right now rather than REITs, than a generalized REIT, because the reason is that in the generalized REIT, or the kind of generalized real estate ETFs, you have a lot of commercial real estate. That's under a lot of pressure right now, work from home, all this stuff that's going on. So, we're focused more on home builders right now, which are, home builders are cheaply valued. And right now there's a lot of home building going on because existing homeowners aren't selling their house, because I'm going to sell my house where I have a 3% mortgage to go buy a new house with a 7.5% mortgage. That doesn't really make any sense. So existing home sellers really aren't selling, which means that new buyers' only option really are to go buy new houses where they can get 4.5% or 5% financing from the home builders. So that's a little bit more of an area that we like in the real estate side, but just kind of broad real estate. Also we like public storage as an example. No matter what happens in the economy, people have a place to store their stuff, and people have too much stuff in the US. So got to have a place to go. But we are avoiding broad-based commercial real estate entirely right now.
I remember reading once that the self-storage industry talks about the 4 Ds that drive their industry, which are death, divorce, disaster, and downsizing. So it's a very cheery, positive sector to invest in, but a good hedge, I imagine.
Yeah.
What about Japan? So the Nikkei 225 is up 25% year to date, and even Warren Buffett has been getting in on the action, buying shares in 5 of the nation's biggest trading houses. And I won't even try to pronounce the names of those companies. Are you already on the Japanese bandwagon, or are you looking to get aboard at any point?
Not really, no. So first of all, we're primarily domestic investors. Our specialty and expertise is the U.S., so we primarily focus on U.S. equities. But Japan has big problems long term, and they're having a rally right now, which is not uncommon. They've had rallies in the past, and we go through this about every 5, 6, 7 years. Japan has a big rally. You go, oh, Japan's back, and then it all crashes again. Japan has rolling recessions about every 3 years. The Japanese central bank owns about 80% of the bond market. They own about 80% of the ETF market. So it's not really a market driven by fundamentals or factors. Demographics are absolutely terrible. 40% of Japanese women aren't going to have children at all. It's just there's no future outlook in Japan that's positive. And it's because of a function of what they've been doing. They're 280% debt to GDP. And again, debt matters a lot. And this is why, they've got to do yield curve control. They've got to keep yields suppressed near low levels, because you can't have, and this goes back to our earlier conversation, in order to sustain the economy, you need to have debt issuance. And if interest rates move too much, you can't issue debt. So interest rates have to remain low. And so in order for us to sustain our debt growth, at some point, the Federal Reserve is going to have to step in and start forcing rates lower in order for us to be able to issue more debt. Interest rates can't remain at this level or higher for very long. Same problem in Japan. So the long-term outlook on Japan is not great. And fundamentally, there may be some trading opportunities there, which I certainly am all for. But again, not really my specialty.
I read that the Japanese central bank owns 63% of locally listed ETF assets as of last month. And the Financial Times article that contained that statistic said in the headline, central banks' heavy participation in the equity vehicles has sparked scrutiny, but no alarm. But to me, that does sound quite alarming, doesn't it?
Well, it is. You got one, basically you have one buyer, right? So, again, that's fine, right? And I find it interesting that Warren Buffett's play on trading houses, again, they generate revenue by trading. So there may be some value there. But again, you're dependent on one buyer, and that's the Bank of Japan continuing to buy. And again, they have to manufacture the money from somewhere, so they have to issue debt to do it. It seems like a bit of a closed scheme, so to speak, in order to kind of keep things moving along. But sustainability, is questionable. But again, this is something this in 2000, we were talking about Japan being a fly in search of a windshield. And that at some point, this whole kind of house of cards would eventually come down. But here we are 23 years later. It's still a fly in search of a windshield, right? Just hadn't found one yet. But again, and this is always the issue. A lot of people look at our debt and go, well, this is unsustainable. I'm going to be all in the bunker now because at 32 trillion in debt, it's all going to fall apart tomorrow. Don't count on that, because again, 23 years later, Japan's still ticking along at 250, 260% debt to GDP. So we can certainly go a lot longer than you think issuing debt we really can't afford to repay. But, that's just a function of how economics works.
So do you think it's more likely that a nation like the US will just keep ticking along like Japan rather than go the way of Argentina and suffer sort of hyperinflation and default? Well,
eventually the thesis is that you'll wind up like Argentina, right? So that's the fear. But the reality is that as long as we maintain our printing press and we can print our own currency and we can pay our own debt off because we can print our own currency, that's not a good thing, by the way. That's just, we have the ability to do it. That we can go on for a lot longer than you think. And again, we'll probably be more like Japan. We've got an aging demographic. We've got an underfunded pension system. This is all similarities we have with Japan. We've got a slow growth economic environment, highly indebted, and we've got to maintain low interest rates in order to keep that kind of game going. So, the reality is that we'll probably wind up in an environment where we have economic growth back below 2%, inflation running somewhere between 1% and 2%, interest rates somewhere between 1% and 2%, because interest rates, inflation, economic growth track each other over time. So we're going to be heading down towards the end of that spectrum. Now, it doesn't mean you're not going to have bumps in economic activity, but you'll have a bump in economic activity, and then you'll have a decline, then you'll have a bump and a decline, but you'll average out over time, over a decade or two or three or four, this kind of just very slow economic growth that doesn't create a lot of economic prosperity. You'll get more calls for socialism. Same things you're seeing now with stuff that we predicted a decade ago. We're just now getting there. And it's just, we can go this way for a long time.
But then eventually the circle goes back around the other way, because I don't know if you read that Argentina had a presidential election on the weekend, and a right-wing libertarian, shockingly, won. So clearly, after too much hyperinflation and debt, you go back to the start, and you go back with conservative politicians by the looks of it.
That'll happen. And look, we've got to go through that cycle. We're in this, I want socialism, communism cycle right now. That all sounds great on the surface until you get it, and then you realize that it's really not all that great, and it doesn't lead to the outcomes that you expect. And then you do begin to start going, okay, hey, that was a bad idea. Let's go back. But this happens throughout history, right? You have England get too far into debt, they go through the dark ages, and they emerge on the other side. And there's other civilizations that didn't make it. Rome didn't make it. But we go through every society goes through this cycle of getting over indebted, going too far, and then you have a decision to make. And unfortunately for our politicians, and why we don't elect better politicians, I don't really understand. But you have a choice. So as a politician today, if you want to elect me president, by the way, if you want to elect me president, we could fix Social Security a little bit at a time, right? We make some small changes today. We make some small changes next year. We make some further changes after that. But we make small changes that over time can fix that problem. We start, fixing our spending problem, start moving us back slowly towards a more balanced budget type economy and market. And by the way, maybe we just get back on a budget and government, which would be ironic after 13 years. But outside of that, so we could make these small changes today, or you can wait, and eventually the bond market will do it for you, because at some point you'll have a complete revulsion of debt and nobody will want to buy it. And then you're forced to make these changes all at once, and it's extremely painful. And you have an Argentina situation, right? So we have choices that we could be making. Unfortunately, just nobody wants to make those tough choices because they're unelectable, right? I talk about fixing Social Security, immediately nobody wants to vote for me. I talk about, fixing government spending and no more checks to households. Sorry, nobody wants to vote for me, right? Because we all want what the government's going to give us, rather than understanding that the consequences are that it's actually taking more money away from us.
Going back to passive investing and the S&P 500, I wanted to get your view on investing in an equal weighted version of it. Do you think that that's something that's recommendable for people who are worried about Nvidia or Apple or Tesla being overvalued, that they could go instead with an equal weighted version of the index? Or do you think that that comes with other drawbacks that I'm not thinking of?
Well, no, I mean, that's exactly. So let's go back to how people actually invest, right? Look, so first of all, people tell me all the time, oh, I'm a long-term investor. Right? I'm investing today for the long term. I've got 20 years ahead of me. Sounds great. Okay. So let's go buy some value fundamental stocks and you'll be fantastic. Low risk, high return over time. But then that same person will come back to me and is like, well, I don't understand why my portfolio is not keeping up with the market, which is up 15% this year. Well, that's a good example of what you're talking about. In the first part of this year, the market was up 15%. Equal weight stocks were basically flat. So everybody was going, well, I don't want to be in equal weight stocks because all the money's being made in the S&P. So they go jump in the S&P just at about the time that equal weight begins to outperform and S&P begins to underperform. But that's how investors always behave over time. Investors always make this emotional mistake of chasing performance, which is what happened in the past, and making these buy high, sell low decisions because of chasing performance, rather than forget about the performance, right? The best investors that I know never look at a statement. They don't look at their account every day. If you open up your account and look at it every day, you're going to have terrible returns over time. And unless you're if you're a day trader, that's fine, but you're going to blow yourself up too. Day traders don't survive long term. Statistics bear that out, not me. So, but the point is that really good investors will make an investment that they believe in. Look, Warren Buffett, right? He'll buy something, say, I'm not going to sell this stock for 100 years, right? Because he knows that the values and the fundamentals are there and he's going to make money over time. But as individuals, we're tied to CNBC or Market Watch or whatever the financial media channel is of the day. And we're worried about the red light, green lights, what's going on. It's a casino. And so we're driven emotionally to, I have to do something because the market's doing this. I've got to make changes. But you only need to make a change of something if your thesis changes. If I buy something for a fundamental reason, the only reason I would need to sell it or change it is because my fundamental thesis has changed. The company ran into hard times or something changed. We no longer need buggy whips anymore. So now we're all driving cars. So maybe my buggy whip manufacturer needs to get sold. Those are things that lead to buy sell decisions, not just price movement up and down.
Mm. And I guess an equal weighted index is more akin to value investing, no? Because the fund sells off the stocks that go up and then buys more of the ones that go down to keep the equal weighting, although it's doing it in a robotic, stupid way, isn't it? Without actually thinking about whether these stocks are worth buying. Right,
but that's not really value investing either. Just to be clear, there's times in the market where things go down and they're still expensive, right? So Nvidia could fall by 50% and still be expensive. Right. So, it wouldn't be a value just because it went down 50%. It's just it'd be down 50%. So, but no, the equal weight index hopes to eliminate some of the market cap bias that occurs. And again, if I buy an S&P index, right, industrials make up about 2% of that index. But if industrials are doing great, then I'm not really benefiting from that because it's such a small percentage of the overall index. Financials make up a big percent of the index. And if they're doing terrible, it really drags down the whole index. So the thesis of an equal weight is, and by the way, this is how we run our portfolio on an equal weighted basis, is that I buy stocks that I like, or I buy an allocation that I like, and then they're equal weighted. So if my bets on industrials pay off, they provide a benefit to the portfolio and it lowers volatility over time. versus what would occur within a market cap weighted index, which has higher volatility.
Moving on to a slightly different topic, do you see now as being a good moment to get exposure to bonds, given interest rates seem likely to have peaked? And if so, what duration?
Yeah, no. So I'm actually writing an article in our weekend newsletter that'll go out Saturday talking about why I doubled my bond position in my personal portfolio. So in my personal portfolio, which is different than my client portfolios, right? Because I can do crazy things in my own personal money. But I doubled my position week before last in long duration bonds because, the function of economics still tells you that interest rates are going to fall and that the Federal Reserve will cut rates at some point. Now, my view for that time horizon is 18 to 36 months. So it's a year and a half to 3 years for that bet to pay off. But I'm willing to make that bet today because of the fundamentals and the economics that in 2 to 3 years, I'm going to get paid handsomely for that. And again, that's about that position could make me up to 50% over the next 18 to 36 months. So if that occurs, by the way, that's not great for stocks. Stock values will be going down because of the fall in interest rates will be akin with a recession, a drop in earnings, et cetera. So if my thesis is right about what happens from here, then I want to be long duration bonds. Now, if you think the market's only going up from here, and then you don't really want to be long bonds because that will suggest that money flows will have to all focus on equities at high valuations for the next 18 to 36 months. But my bet is that we get a reversion back towards long-term growth trends economically, inflation-wise, et cetera, which means lower rates, higher bond prices.
And what would you say to someone who's just 100% allocated to equity? Do you think that it's advisable to have at least some allocation to bonds for the sake of diversification?
Well, again, that kind of gets into personal, financial goals, et cetera. If you're young, if you're in your 20s, there's no reason to own bonds because stocks will give you a better return over the next 30 to 40 years. There is certainly a very good reason to own bonds here from a capital appreciation standpoint, where we are economically. But again, that's an investment decision based on, my analysis and my views. And I certainly suggest that you do your own homework and try to figure that out yourself. But, there's, what bonds provide are a bit of, to your point, do provide diversification. They do lower volatility risk in the portfolio. They do provide interest income, which is another income stream to your portfolio. So there's no reason really not to own bonds. But if you own bonds in your portfolio, you can no longer look at the S&P and go, well, why am I not keeping up with the S&P? Because the S&P owns no bonds. So if your goal is to track an index, you can't own bonds. If your goal is to grow money over time conservatively and create return for yourself and protect capital from downside risk, then yeah, you definitely want to add bonds to your portfolio.
This channel is called Resource Talks, and most of the listeners have a bias towards investing in physical metal funds or mining companies. So I have to ask you, do you have any allocation to commodities?
Not right now. We don't at the moment because, we had positions before. We trade commodities more than we hold them because commodities are a tradable asset. They basically, in a lot of cases, they have no underlying revenue stream. They have no dividend yield, et cetera. So the issue is for us is that they're more of a tradable position. And we haven't owned a lot of hard commodities here as of late. We own a few, we own some companies in our portfolio, like Albemarle for lithium and some companies like that. But we don't own any direct metals because of the lack of income that come from them. Again, no dividend yield or interest income stream. And they are a pure play in terms of just an expectation on changes of commodity prices. And again, gold as a factor has not performed well over the last couple of years. And so one of the things that we try to watch very carefully in our portfolio is drag. So if we have a position that's not performing, then that's something we don't want to own until it starts to provide positive benefit to the.
Is it necessarily just a short-term trading position there? If you've got sort of a long-term thesis about the adoption of nuclear energy or something, couldn't it make sense to buy just a physical uranium holding or a big uranium miner like Cameco for the long term?
Yeah, if you believe that nuclear energy is going to be a big adoption, and that we're going to go back to building nuclear power plants, then that would be a logical play. And again, buying the company would probably be a better way to do that. But there's where we're headed right now. The focus is anti-nuclear because nuclear bad, oil bad. We have to do everything in batteries, which makes no sense. But that's the way that the world is focused right now. It takes 10 years to build a nuclear plant. We just opened up a new one in, I think, Louisiana just recently. But it takes 10 years to get one of those off the ground. So if we're going to start even talking about, getting more towards nuclear energy, we got to start those talks today, because by the time you even crack ground on one, that would be 5 years out. Then it'd be another 10 years to actually get the thing up and operating. So you've got to have a really, really long time horizon. If your idea is to buy nuclear energy and it's going to be the thing, you're going to have a 20-year window for that play to play off.
Yeah, of course. I mean, there are other countries in the world, of course, though, who are moving more quickly, like Japan or China. Even in the UK, they're talking about those small modular reactors. But before we finish, I've got to ask you this question. This is a rinse and repeat one that we have. And I know that it's your job to make money for people, which is why I think it's going to be amusing to ask you. If I gave you $1 million and said, lose this for me as quickly as possible, what would you invest it in?
Lose it?
Yeah.
Wow. What would I invest in?
It's sort of inverting your normal thought process, isn't it? Yeah.
Well, yeah. That's a big inversion. To lose it, I would probably have to start thinking about buying, companies that eventually go bankrupt. There's a few out there. AMC probably is one. Some of the meme stocks that we talked about previously and the last couple of years, there's probably quite a few of those companies that are going to go towards zero at some point. That's just a really complex question to ask me, because I'm very optimistic in nature. So thinking about losing money does not inspire me.
Does not compute. Yeah.
Yeah. Well, it doesn't compute. It's just not something that you have to intentionally set out and go, I'm going to invest in this to lose it. I mean, maybe just go to Vegas and bet on black, Yeah.
Yeah. Lance, it's been a great privilege to get the benefit of your knowledge and experience. Before we wrap up the conversation, is there anything that I didn't ask you about that you'd like to mention?
No, I think you pretty much covered the depths of my knowledge. So I think we're good.
Fantastic. And where can listeners go to keep up with you and your work?
Realinvestmentadvice.com is our website. We publish daily market commentary. We publish 2 or 3 blogs a week, a weekly newsletter. We've got a video channel as well. So we do a daily podcast. So but tons of information about what we're doing, what we're thinking. Like you said, the articles you were pulling up, they're all on our website.
How's it going, everybody? I'm just making a quick appearance. I'm going to be off your screen here in a second. First of all, because of my narcissistic tendencies, of course, but also because I wanted to show you a clip from a conversation that Mark had with Michael Howell a couple of weeks ago. He mentioned him at the beginning of this episode, and I thought, people really hate clicking on other videos. So I thought I'd just insert a clip in here where they talked about global liquidity and why that matters. And I think this compliment, it's interesting to hear after you just heard that conversation that you just heard with Lance. So, but if you do want to watch the whole conversation where they talked about the BRICS potential currencies, they talked about gold, interest rates, Japanese stocks, the US versus China. They talked about AI. Again, they talked about more about liquidity, the British pound, and so on and so forth. It was a long conversation. It was a very interesting one. I think Mark did a good job. So, I'll link it anywhere if you want to watch it. And do let know, Mark, that he's doing a good job. I see that he gets fewer comments that I would like him to get. So let him know that he does a good job, because I think he does. So, if you care about these things, watch that conversation. If you don't. But here's that clip.
Mark, I'd like to start by getting your big picture view. So if we were standing on a mountaintop together, overlooking the global economy, what would we see?
I think we'd see, first of all, the beginnings of a liquidity cycle that bottomed last October 22, and is likely rising to a peak, which may occur sometime around late 2025, early 2026, that sort of time frame. It won't be a straight line up. These cycles never are. But I think the key point is that investors, both in stocks, general financial assets, and ultimately commodities, will now face the wind behind them rather than the wind in front of them. That was really the story of much of last year and maybe a bit of the year before. So I think there's a definitive change in the cycle. Now, liquidity is a leading indicator. I'll define maybe a little bit better what liquidity is in a moment, but it's a leading indicator. It leads economies. It doesn't follow economies. And as liquidity is now rising, you'd expect signs of stabilization beginning to occur in the world economy. Now, I think if you're taking a commodity or resource slant, which you clearly are, within that mix, one needs to look at who are the key drivers of commodity markets. And what it really comes down to, I guess, is sort of two big players. One of those is obviously the Federal Reserve. The Federal Reserve controls the denomination of commodity markets, in other words, the US dollar and what's happening to the dollar. And the other is who creates the demand for commodities in many ways, and that's China. So one's got to look very closely at the People's Bank of China. So it's more than Fed watching. It's Fed watching and PBOC watching, but more generally, we think of the whole pool of liquidity, and we monitor what we call the global liquidity cycle.
So you talked about liquidity being the fundamental driver of markets, but hasn't the Federal Reserve been doing quantitative tightening? In other words, allowing treasuries to roll off its balance sheet? And doesn't that involve liquidity being sucked out of the system? So how can you be bullish in that backdrop?
Well, I mean, the answer is a very good question, and clearly that's the policy, that's the obvious or headline policy that they're following. They're saying that they're basically doing QT, quantitative tightening. They're shrinking the balance sheet. They're not really saying they're taking liquidity out of the system, and I would argue they're no longer doing that. The risk of doing that is that if you take enough liquidity out, you'll create financial market tremors. You'll trigger bank crises or whatever. And after all, didn't we just get that with the failure of CSFB, SVB Bank, etc.? Those are really problems that the financial system encounters through low liquidity. And basically what we're arguing is that that's now behind us. The Federal Reserve is actually beginning to add liquidity, and it's doing those through different channels. The mistake that I think a lot of analysts make is to look at the published balance sheet of the Federal Reserve and not to make appropriate adjustments, because all items on the Fed balance sheet are not liquidity creating. Some not liquidity creating or liquidity destroying, I should say. Some of those will have different effects. And basically what you've got is, let's say, a left-hand side of the balance sheet, the asset side, Fed assets, which has generally been increasing, despite the fact that you've had a roll-off of treasuries, as you rightly say, in terms of their security holdings. And the reason for that is that primary credit, in other words, discount window borrowing by banks has jumped, and also support through something called the Bank Term Funding Program has also increased Fed credit. So there are items that are directly offset the roll-off of treasuries. On the other side of the ledger, if you look at basically what else is happening, there have been two items that have also influenced things. One of them is called the Treasury General Account, which is basically the Treasury's float at the Federal Reserve. That has fluctuated. It was drawn down significantly during the period of the debt ceiling in the US. That adds liquidity to markets, and now it's being rebuilt, and it should detract from liquidity. It would do, bar from the fact that the other item on the liability side, the reverse repo account, has started to drop precipitously. The reverse repo account drained $2.5 trillion of liquidity out of the markets at its peak, and it's now falling fast. It's about 1.7 trillion, and that drop of about 1.7 or about 1.8 trillion has basically been has occurred over the last 6 months or so. So what you've got is a significant injection of liquidity going to the system. The fall from 2.5 trillion to 1.7 is very meaningful.
And at what point then did this situation change and liquidity start increasing? Does that correspond with the movement that we've seen in equity markets upwards this year? Or was it prior to that?
Yeah, I mean, the answer is that basically the cathartic change was the British gilt crisis in September of 2022. Now, that may have been a blip on most people's radar screens. In other words, it was an event, but it wasn't a particularly deleterious event. Our point is that had that occurred in the US Treasury market, there would have been another 2008 type crash. In other words, this was a big event for a major bond market. It so happens that the UK gilt market's not that important anymore. The US Treasury market is. And I think that was a wake-up call to policymakers worldwide, particularly the US Treasury officials, to say, look, we've got to be very careful here because sovereign bond markets are really the main plank, if you like, of stability in the financial system. And if you start to see wobbles in those major sovereign bond markets, then we've got big trouble. And the reason for that is that since the 2008 crisis, most lending in markets has been collateral based. And the collateral that is used for borrowings basically are sovereign bonds, particularly US Treasuries or German bunds. These are critical items, securities. If they fall in value, then you've got an immediate threat of a credit crunch. So there's a sort of doom loop involved in this whole process, which means that central banks and policymakers have got to be a lot more alert to what goes on. So I think that what you've got to start looking at is a very broader view of who operates or controls financial markets. It's not just the central banks, it's also the treasuries as well. And in terms of what the treasurers are doing, the profile of their issuance and the timing of their issuance is very important in terms of market stability. Now, let me just give you two quick heads up about that. One of those is that the US Treasury at the moment is increasing issuance, but it's focusing very much on the short-term bill market, not on the coupon market, in other words, Treasury notes or bonds. So in other words, everything is going through at a maturity below 12 months, or a large part of that. Big significant increase in bill issuance. Now, that is basically raiding money market funds, or the balances that money market funds had in the reverse repo facility at the Fed. So they're basically using money that was, if you like, sterile on the sidelines to fund government activity. And that clearly is not draining liquidity from the overall system. Arguably, maybe it's actually boosting it. So what you've got is a situation where actions of the Treasury are important. Another thing that's occurring is that the Treasury is slated to do Treasury buybacks from next year. Now, we don't know what form that will take exactly, but broadly speaking, what they'll endeavor to do is to buy in stale, old, long maturity treasuries, off-the-run treasuries, as they're called in bond speak, and they'll basically issue new on-the-run treasuries at a shorter maturity. Now, one of the things that will do will be to, A, reduce duration in the market, which is like a liquidity boost. And the other thing that they'll do, the other thing that does, is it makes the market more liquid because effectively a new on-the-run treasury tends to trade at a higher price than an old treasury. So you've actually got better liquidity in the system. The Treasury in the US is doing that. So what you've got is effectively the Fed and the Treasury acting together. And what I would say, sort of as a last comment, this is a bit of an extended answer, but as a last comment, look, if the Treasury is doing this, it's focusing its issuance, or it's targeting its issuance on the money market funds. It's talking about Treasury buybacks. It's clearly concerned about liquidity in the system. And that tells me they do not want to pull it down. They don't want another SVB. They want to end the regional bank crisis. They don't want to stir it up. So that is really the flaw in the system, if you like, the flaw as in FLOOR, the floor of the system that we're looking at. And, we've reached that floor. Markets are moving up on the back of that. The first trigger was the UK gilt crisis. The second was the SVB crisis.